We know options are priced using the following inputs: stock price S, exercise or strike price K, time to maturity T, volatility V, and risk-free rate R. The question is therefore raised, how sensitive is the option price to changes in these inputs? In option jargon, the sensitivity of option prices to the different inputs are called the Greeks because of the use of Greek letters, although one is not actually Greek, but we're getting ahead of our story there. These sensitivities are used dashboard style for traders to get a pulse of their positions relative to the options they use. It's quite useful in normal markets. However, during the 2008 financial crisis, it turned out to be an exercise in futility as traders floundered helplessly in the face of exploding volatility, financial markets crashing together, and credit getting squeezed. So in this video, we'll discuss not just how to compute the Greeks, but also how to view them as a tool, and what to do especially in the face of non-normal markets and excessive volatility. We will also review Excel data tables for us to do some scenario analysis for stress testing, rather than merely rely on the option Greeks for whatever risk management needs we might have. So what are option Greeks? Well, the Greeks measure how sensitive an option is to each of the inputs to the option price. For brevity, we will only focus on call options, although the discussions below also apply to put options. Now think of the call price C as the function of the aforementioned inputs. The Greeks will be references to the partial derivatives of this function with respect to the different inputs. But rather than talking about partial derivatives, we will focus on the intuition behind this and how to use this in real life. Let's look at the most important ones. Delta, the sensitivity to stock price. Delta tells us how much an option's price changes when the stock price changes. We can write that down in terms of finite differences as follows. Delta is referenced by delta C, the call option price, all over delta S, the stock price, or more importantly, the changes in call and stock price. Okay, so what does this mean? This is the change in the price of the call option, delta C, as the stock price S changes, or delta S. Notice we are using delta twice as the name of the option Greek and using it for that triangle notation for finite difference. Well, that's also called delta. Just kindly note this. So for example, if an option has a delta of 0.50, a $1 increase in the stock price will increase the option price by about 50 cents. So think of delta as the speed or velocity of the option relative to the movement of the stock price. The larger the delta, the more closely the option moves with the stock. Gamma, how delta changes. Delta itself can change. Gamma tells us how quickly the Greek delta changes when the stock price moves. It's like a speedometer. It considers how the speed changes as the stock price changes. And in calculus terms, it is the second derivative of the call price relative to the stock price. A high gamma means the option can become more sensitive very quickly. Think of gamma as the speedometer for delta, and you can think of it as a change in the option delta over the change in the stock price. So gamma can be referenced as delta of the delta all over delta of the stock price. Theta, the cost of time. Every day that passes brings an option closer to expiration. Theta measures how much value an option loses because of the passage of time. This is called time decay. Every day, a little value escapes. We can think of theta as the change in the call price over the change in time. So theta is referenced by delta call price all over delta theta. VEGA, the sensitivity to volatility. VEGA measures how much an option's value changes when volatility changes. If traders expect large future price swings, options generally become more valuable. In fact, options are all about volatility. And in a market that can suddenly become very volatile, that's where options really come into play. More uncertainty often means higher option prices, and at the extreme, markets could simply freeze or break. We can think of VEGA as the change in the call price over the change in the volatility. That is, VEGA is referenced by delta call option price all over delta volatility. By the way, VEGA is not actually Greek, but it's quite handy to use to remember that it's all about volatility. So VEGA makes a lot of sense. And if you're thinking casino wild volatility, think Las Vegas and therefore VEGA. Rho, the sensitivity to interest rates. RAW measures how option prices respond to changes in interest rate. For most short-term retail trading, RAW is relatively small, but for long-dated options and institutional portfolios, it can matter. Think of RAW as the interest rate gauge, denoted by the change in the call price over the change in the risk-free rate. That is, RAW is referenced by delta call option price all over delta interest rate. The problem with the Greeks. As you can see from the foregoing, all the numerators are the change in the option price, the call option in this case, divided by the change in the underlying inputs. The exception is gamma because it measures the change in the Greek delta per change in the stock price. So what this all really does is track the movement of the option price per change in inputs, right? In theory, it's supposed to help with risk management. However, the sensitivities discussed here are expressed as small changes, and in the limit, they talk about infinitesimal changes. During the 2008 financial crisis, the research I did at the time talked about how useless they were all, given the huge drops in prices and huge jump in volatility, something that infinitesimal calculus is ill-equipped to address, and where robust stress tests matter more than the calculus. And remembering our previous lessons, the assumption of log normality makes all these models problematic when log normality itself breaks down, in the same way that major breakdowns in normality also break down the value at risk models. So remember that these are just tools that guess underlying realities, and when assumptions break from reality in a big way, none of these tools will work properly. And therefore, we need to talk more about scenario analysis and thinking about the intrinsic relationship between option prices and the change in the input more generally. We will still discuss the option Greek, even provide both the intuition using finite differences and the Greek computations using our QUANTPROF option spreadsheet shared before in a previous video so that you can do the computations yourself. However, what is more important is to do robust stress testing, and we'll start with that. And to do this, let's review Excel data tables and how to use them for our purposes. Excel data tables help you do scenario testing by plugging each input in column or row form into an active formula, then detailing each and every formula output in a corresponding column or row. For our purposes, we'll use column of inputs, and the output will be the call and put option prices. We reference which output cells will the column inputs populate by putting them at the top of the table. The input columns will contain the stock prices we want to do scenario analysis with for the first table, and the volatility or standard deviation for the second table. Next, we lasso the data from the topmost part of the table to the bottom of the table like this. Then we select data from the menu, select what if analysis, then select data table from the menu. Next, we select column input. Then select which cell do we want our input variables to populate, then we press OK. We can do the volatilities next, but this time the input cell is the standard deviation and not the stock price like in the previous data table. This way you can test for large movements in the inputs and see how the option prices behave. In the case of the stock, we can see where the option prices lose value as the stock price changes. And this will be more robust than what the Greeks measure. And here's the video demo. But how do we compute the option Greeks in spreadsheets? Using the QUANTPROF option spreadsheet, we find that the Greeks are included functions that you can use for both calls and inputs. Just click on the formula bar and partially type BS for Black-Scholes, by the way, and not any other BS, in the search part, and out will come all the Greeks in the function selection. Select which function you want to use and then click on Insert Function. For our purposes, we will use BS called THETA to demonstrate how to work the functions as follows. By the way, the rest of the functions are already worked out and displayed below separately for easier access. This will prove useful to show how they can be worked out even without knowing coding. the option Greeks using data tables. Now we'll show how to approximate the option Greeks by changing the input variable by a small amount, say 0.00001, and taking a look at how the call price changes using data tables rather than our QUANTPROF functions a while ago. We take finite differences, the delta of the call price, the finite difference or delta of the input variable to compute the Greek, and compare that to the ones generated by our functions a while ago. Note that we will use the data table for just 2 scenarios per input this time. Again, the computations are worked out for you already and displayed separately below. Try to compare them directly. Also note that for theta, we need to put a negative before the number because it's a present value number and the exponent is negative time. So just attach the negative sign if you are using data tables. In real life, there won't be major jumps in time or interest rates relative to stock prices and volatility. So what would be more crucial is to take a look at the robustness of your results when there are big jumps in stock prices or volatility more than anything else. For this, the earlier data tables using big movements in stock prices and volatilities are as important, if not more important, for risk management and stress testing than the finite difference methods used for the Greeks. So there you go. This is what the option Greeks look like and what they answer. And we hope this video is helpful for those in university or preparing for credentialing exams or for newbie professionals learning about options. Well, that's all that we have for now. Kindly like and subscribe to help support the channel. See you next time.